Let us look at the conservative method adopted by the private bankers for assessing working capital. So how do they do it? They always link the working capital with the sales. Unlike earlier method where the focus is more on cycle, because the cycle could vary according to business, here almost a uniform cycle is applied for all business. How? The focus is with sales. So whatever the sales that is getting estimated, on which certain percentage is going to be applied, and that's going to be the eligible working capital or say cash credit limit. Of course, that will be linked with the available security. So how to go about? Let's say we are going to have some 3 years figures. Okay, let's say year 1, year 2, year 3. In year 1, the turnover of the company is 80 million. In year 2, the turnover is, let's say, 100 million, and in year 3, the turnover is 100 and say 30 million. Okay, so now we are focusing on year 4, and let's say that's the year we are estimating. Okay, estimate, and it's for this year we are looking for cash credit. Now the cash credit is going to be linked with the estimate that is going to be made for this year 4. So what the customer would do, if you want to get more cash credit, he may give a higher estimate. He may say that he will achieve a turnover of 200 million. Okay, up to year 1, 2, 3, his turnover is only 80, 100 and 130, but in year 4 he may say that his turnover would be 200 million, basically with an intention to get a higher cash credit, because banks are going to apply some percentage on this estimate. So what those banks would do, they try to take this with some kind of weightage. They don't want to take this 200 million blindly, so they want to apply some weightage. So what the bankers are going to do, so they'll have some threefold approach. It means they are going to trim the estimate that is given by the customer. It means they will have three kind of figures, and only one of the figure would be used for say one of the figure would be considered as estimate. It means now we have estimate given by the customer. So I'll say estimate given by customer is something like this, 200. Okay, the bank would have some kind of policy where they may say that they will apply a fixed percentage growth in the last year. That's all. Okay, it means say something like 20 or 25% growth over the previous year. So I'll say 25% growth over previous year. It means the previous year is 130, so 130 plus 25%. So we can say 130 multiplied by 1.25, it's going to be 162.5. So if this parameter is considered as a estimated turnover, then turnover have to be freezed at 162.5, whereas the estimate given by the customer is 200. So we have to see whether there is that possibility that this company would achieve, or this customer would achieve the turnover of 200 million. So the banks may have one more criteria where they will apply average growth over previous year turnover. So what is going to be the average growth? Look at here, between year 1 and 2, what is the growth rate? Between year 2 and 3, what is the growth rate? Then try to apply the average. So if I measure the growth between year 2 and 3, say it's 100 minus 80, so that gives you the growth, that is 20 divided by 80. So what is the growth here? The growth, if I express as percentage, it is 25. Similarly, I have to do between year 2 and 3, and very apparently we can see it's a 30% growth, because it is 130 minus 100, 30 over 100, it's 30%. So we have to apply, or we have to take into consideration the average growth. So average is very simple. We'll say average of these two, and it's going to be 27.5 actually, right? So if I apply this percentage over the previous year turnover, that is on 130, then I'll have some growth. So let's see, it's going to be this 130 plus 130 multiplied by this growth rate. So we get 165.75. So we are having three different numbers now. The estimate given by the customer is 200, 25% growth over previous year is 162.5. Average growth over previous year, okay, it means we are determining the estimated turnover by applying the average growth over previous year turnover. We know previous year turnover is 130 and average growth is 28 or say 27.5%. So we get 165.75. So now the bank would take one figure as an estimate. Okay, which figure? Of the three, whichever is lowest. So the bank would consider only this figure because this is very conservative. So this is going to be the estimate which they are going to consider. Now it is only on this estimate they will apply a percentage. Okay, so they may say CC limit is nothing but 20% of estimated turnover. So it's going to be 20% of what? It's going to be 20% of 162.50. So if we calculate that now, let's see what we get. If we are going to do that, we get 32.5. So this is the CC limit that is eligible for this business entity based on the conservative method. But again here it is purely linked with the financials and purely linked with the projections and the past. And we have to ensure that if the bank is very particular about the security, then this 32.5 is adequately covered by the security. So for that we have to look into the loan to value norms, because the banks will have something known as LTV norms, and let's say they are going to give some security. Security is something like say land. Then land means the comfort level could be very low for the bank, but if it is something like residential property or say commercial property, the comfort level will be high. Okay, because if it is land, then bank would be willing to give only say 50% of the land value as a loan. But if it is residential property where the promoters are staying, then the bank may even go to the extent of giving 100%. If it is commercial property, they may go even to the extent of 90%. Okay, so here the CC limit is 32.5. If this customer is going to give land, then for getting this 32.5, he should offer 65 million worth of property, because on 65 million, 50%, 32.5. Okay, if he is giving a residential property, then 32.5 by 100%, it's sufficient if he's giving 32.5 million worth of residential property. If it is a commercial property, then it's going to be 32.5 divided by 90%, then he should give 36.11 million worth of a property. So here, if he has properties for these values, then he is safe. Now, instead of these level of securities, let's say this particular customer has a lower amount. Say for example, instead of having a land of 65 million, let's say he has a land worth only 50 million. Then in that case, 50 million multiplied by 50% based on the land value, or we say LTV, his eligibility is only 25, whereas the assessment says 32.5. In that case, the bank would compare these two. So they would go for whichever is lower. So even though the assessment permits 32.5, the security is permitting only 25, so the bank would go for 25 million. Similarly, let's say instead of 32.5 million worth of property, they have only say something like 30 million worth of property. Then if it is a residential property, then there is a possibility the bank can go for 100%. Then bank may go for 30 million. Okay, they cannot permit 32.5 because the security is lesser. So here CC is going to be 30 million. And let's say the commercial property that is available is only 35 million. Then on 35 million, the bank may lend 90%, which is 31.5. Eligibility is 32.5, but whichever is lower is going to be the criteria. So the bank is going to consider only 31.5. So to sum up, how the banks would sanction cash credit facilities. Number one, they'll see say 20% of turnover. Number two, they'll be comparing the LTV and they'll take a decision whichever is lower.